Hi, this is the end of the year tax preparation checklist for small business owners, brought to you by Wright Way Consulting. My name is Carrie Lorick. I'm a certified internal auditor as well as a licensed tax preparer and a business owner. I own Bottom Line Tax Solutions in Baltimore, Maryland. I have over 2 decades worth of experience working with small businesses. Here's the tax preparation checklist I put together for small business owners. There are 7 steps, and I'll go in detail in the following slides with each step. But here's a list of all the steps we're going to cover. 1. Obtain an accountant. 2. Account for all revenue. 3. Ensure all expenses were recorded. 4. Reconcile bank statements to accounting records. 5. Ensure all payroll forms are filed. 6. Close your books and create end-of-the-year financial statements. And 7. Make fourth quarter estimated tax payments. If you already have a trusted accountant that you like, you're in great shape. You can skip this step. You're good. But if you don't, now's the time to find one. When I say now, I mean December, not in February or in March when you're in desperate need and you'll get whatever accountant doesn't have a lot of business, which is probably not a good sign. So here's some tips to help you find one. First tip, ask your network for referrals. When I say network, I'm talking about your friends, your family, your coworkers, your clients. You can even go in a local Facebook group and ask people who they recommend or use themselves. Also, review the accountant's credentials. So, are they a CPA? Are they a licensed tax preparer? I've seen on rare occasions where I got a new client and the tax preparer that they paid never filled out that they were a paid tax preparer. That leads me to believe they're not licensed. In the state of Maryland, you can't actually prepare anyone's taxes for compensation unless you're a licensed tax preparer or a CPA. So make sure they have credentials. Ask them if they're taking new clients. You may also want to ask them how their fees are structured and if you'll receive a price up front. So what I do is whenever I have new clients call me, they'll always ask, how much do you charge? Well, there's a wide variety of tax clients and therefore a wide variety of prices that I charge. I have multi-million-dollar businesses. I charge over $1,000 to prepare their taxes. And then I have someone who is elderly on Social Security, has a little bit of pension income, and they're charged $100. Most people are somewhere in between. So what I do is I will ask a new client for their previous year's tax return and then give them an estimate based upon that. Of course, that can vary a little depending if the following year something changed, but usually most of the time it's pretty close and things are relatively the same moving forward year to year. The other option is I will have them send me their current tax year documents. So that would be maybe around January, February. Go through it and then give them an actual price up front before I do any work. Therefore, if they're good with the price, they can pay me. If not, they can go and find someone else to do it. Also, you might want to schedule an appointment depending how busy they are. So if you find an accountant in December that you would like to use for the upcoming tax year, you may want to schedule an appointment with them sometime in February or March for them to kind of go over all your information and do your taxes. The second step is account for all revenue throughout the year. So that includes all receipts from sales and services, minus any returns that were made, plus any business interest that was received from business checking and savings accounts. You may also receive 1099s. So you're going to want to make sure that any income reported on a 1099, you also allocated to the business. So you may receive a 1099-K. That's from third-party payment processors. That would be if you accept credit cards or use PayPal or use Venmo, where they have the business payments, where you have business payments with Venmo. So any third-party payment processor, they're probably going to send you a 1099-K. Now, that's going to be the gross receipts on the 1099-K, which is probably not what you actually receive because their fees can be pretty high as far as processing goes. So you want to make sure that you accounted properly, not only for the total revenue that the 1099 is saying that you received, but you also expense their fees that they're charging for using their services. You may also receive a 1099 NEC, so that's non-employee compensation. And that is if you were to perform services for a business. It's very common that a lot of businesses will also receive a 1099 NEC. You could also get a 1099 miscellaneous, and that would be if you received rent payments or if you received payments for things outside of employee or non-employee compensation or contractor compensation. There are other income items that you may receive if, let's say, you're getting a state or federal grant for your business that you would have to report. Or if you're getting rental income. So let's say your business has a warehouse and you decide to rent out a third of it to another business. You would have to account for that rental income. Step 3, ensure all expenses were recorded. So the more expenses that you record and offset the actual taxable revenue that your business received, the less income taxes you will be paying. So you want to make sure that you properly account for all of your expenditures. You also don't want to overstate them because if audited, then they would be thrown out and you'll end up owing taxes to the IRS or the state. But let's look at some of these expenditures. Cost of goods sold. To determine the cost of goods sold for the year, you want to take your beginning inventory dollar amount. So that's basically what was the ending inventory dollar amount at December 31st, the year prior. Then you're going to include any purchases that you made for inventory to sell, plus anything that you paid for labor or materials to make the inventory at a level that you could sell it at. The ending inventory dollar amount would be what you have left at the end of the year, which would be December 31st if you're basing your tax year on a calendar year. Now, one thing to bring up, this inventory dollar amount, this is the amount of money that you paid for the inventory that you are selling, not the value that it's going to be sold at. That's something different. So that's an important thing to kind of think about is this is literally just your cost. So when you're coming up with your ending inventory dollar amount, usually that would be how much you paid for the inventory that you have on hand at the end of the year, not necessarily what you could sell it for. You also want to account for any advertising, supplies, rent, internet, insurance, professional fees. Depending on the business, you could have a multitude of different expenditures. So this is just to kind of give you an overview of some of the major ones. We'll talk about payroll, which was also another major expense, a little bit later. Home office. So the IRS is extremely strict with what qualifies and doesn't qualify as a home office. And they are very quick during an audit to eliminate the home office expense from your taxes. Therefore, then you would owe money plus penalties and interest. So, if your home office consists of a desk in your bedroom, a desk in your kid's playroom, it is not going to qualify as a home office. To qualify as a home office, It has to be a designated space in your home that nothing else happens in or that you don't do anything else with besides conducting business. Then what you would do is determine the square footage of that space, and then you would have a percentage based upon the total square footage of your home. So what you would need to do is you would need to determine the entire home cost and expense for mortgage interest paid, property taxes paid, any repairs made, electric, water, gas, HOA fees, trash removal, etc. Give it to your accountant, and then a percentage of all those expenses for your home can be written off with the home office expense. We also have travel as a major expense that a lot of businesses have. So another thing the IRS has been very strict with is, let's say you buy a new electric vehicle and you say, okay, this is my business vehicle and I'm writing everything off. If you're driving that vehicle 50% for personal use, 50% for business use, the IRS is not going to allow you to write the entire thing off. So the best way to determine, A, that it is in fact a business vehicle, as well as the percentage of miles that are used for business versus personal, is to have a mileage log. It's actually required by the IRS. To have an effective mileage log, at a minimum, you should at least have the date that you drove somewhere, where you started from, which probably would be your home office, to, let's say, a client's location, and then back to home office. So you would put the locations of where you went and the total mileage for the day. You also want to keep track of any parking expenses that you paid, tolls, if you're traveling not locally, maybe even out of the state, out of the country, your airfare, your hotel, public transportation, and even Uber and Lyft you can expense. The fourth thing you should do at the end of the year is reconcile your bank statements and credit card statements to your accounting records for your business. Make sure that you have recorded all your business revenue and expenditures. I guarantee you, if you get audited by the IRS or the state that you live in, they're going to look at your bank statements and potentially the credit card statements as well. So you want to make sure that you have everything recorded. The fifth step is you want to ensure all payroll forms are filed on time. As a business owner, it's on you to make sure that you file everything with the IRS and the state that you live in by January 31st. So, if you have a lot of contractors, you probably are going to want to create 1099 NEC, so that's non-employee compensation. And the form 1096, that's the informational form that basically lists how many 1099s, NECs you gave. For my tax clients, I tell them that I need all of their contractor information by January 15th just to ensure that we get it filed on time. So you have to give the 1099 to the contractor, but you also have to file it with the IRS. There are some steep fines for not filing on time and missing the January 31st deadline. So make sure that you file all of them. The information that your tax accountant would need for issuing a 1099 NEC would be the contractor's name, their business EFIN or their social security number, mailing address, as well as the total amount that you paid them. If you pay a lot of independent contractors for their services, the majority of your expenses could be related to payments. So you need to ensure that the contractors are issued 1099s at the end of the year to support your business expenditures related to those payments. Now, you also, if you have employees, you probably have a payroll company that'll process the W-2s as well as the W-3 for employee wages, and the 940, which is federal unemployment form, and the 941, which lists the Medicare, Social Security, and federal taxes paid, as well as any state income tax forms that need to be filed. Just make sure that it is filed to the IRS and to the state that your business is in by the deadline. As the business owner, even if you use a payroll company, it's your responsibility to make sure that these are filed on time. You also will probably have to distribute the W-2s to your employees. The payroll company will give you the W-2 information and the W-2s. It's just a matter of whether you're going to hand it to them, mail it to them, or email it to them. Step 6, close your books and create end-of-year financial statements. For most small businesses, a profit and loss statement is all that you need. A profit and loss statement literally just lists all the sources of revenue minus your expenditures, and did you net a profit or did you net a loss? This is needed for most small businesses to get loans. However, if you have a partnership or a corporation, you'll need additional financial statements like an income statement, a balance sheet, a cash flow statement, and even a statement of owner's equity. One thing to mention is there is an exception. If you have a partnership with less than $1 million in assets and gross receipts, so that means not the net revenue, but just the revenue coming in, less than $250,000 per year, you don't have to report a balance sheet on the 1065, which is the partnership tax return. You can if you want to, but it's not necessary. Last step, step 7, make fourth quarter estimated tax payments. I cannot stress this enough. I do this exercise with all of my tax clients, and there's some that I will give them, okay, this is what you need to pay each quarter to the IRS as well as to the state of Maryland, so you don't owe a bunch of interest when we file your taxes because you didn't make payments throughout the year, and they just don't do it. But my suggestion to you is make quarterly estimated payments. Do not wait until the next year when your taxes are filed to actually make a tax payment. You are going to pay so much money and interest from the IRS, and if you live in Maryland and your business is in Maryland, to Maryland, for not making payments throughout the year. So to avoid paying more money in taxes and interest, make sure you make your quarterly estimated tax payments. Now, the fourth quarter estimated tax payment is due January 15th. Let's say you just created your business in October or November. I highly recommend, if the business had a profit, a net profit, for you to make an estimated tax payment for that year by January 15th. Thank you so much for watching. I hope you found this information helpful.